Welcome to the Profitable Farmer podcast, where we share stories and tips to help you run a better farming business and create your very own freedom farm. If you're looking to work smarter and not harder in your farm business, welcome. You're in the right place. G'day and welcome again to Profitable Farmer. I hope the season is finding you well. There are times where I feel like it's ideal to bring in the brains trust. And so I am in this podcast calling on two very clever gentlemen who can offer us some really useful insights, given the agri-economic climate that perhaps we find ourselves in. Reflecting on this, we've entered into a period where we're experiencing inflation broadly, increasing interest rates and potentially softening commodity prices. And I think that has a lot of us on the back of a couple of very good seasons asking ourselves some questions around the strength of our business model, whether we've got our cost base right for what's coming. And I think they're really good questions to be asking. And so I wanted to explore exactly that topic. And I've invited FOA Director and Founder Greg Johnsson to join us. And also you might remember Jeff McDonald, Executive Director of RLS Lending and Agribusiness, who I interviewed both on episode 98 and episode 85 of this podcast. So on the back of this, you'd do well to go and listen to those two podcasts. Greg and Jeff, welcome to you both. Greg, first, if I could, what's your sentiment on what we're seeing compared to how life was for us perhaps 24 months ago?
G'day, Jeremy, and good day, everybody. It's nice to be with you today. Things have changed quite a bit. 18 to 24 months ago, we were going through what I would consider to be a rural price boom in all aspects. Basically, we had the perfect storm. I think we had massive demand for land on the back of very high commodity prices across pretty well all commodities. We had good seasons generally across the country after the 18 and 19 droughts. We had massive demand for land, so really rapid accumulation of wealth on the balance sheet of most people who own farming land. So it was an unbelievable, in the 40 years of the time that I've been involved with farming and the agriculture industries, I've never seen a period like it where we've had the juxtaposition of all of those favourable things coming together. And it was never going to last. It was always going to be a temporary scenario. And those people that had good business models and had good cost production and so forth were able to really capitalise on those years and make very high profits. Profits like I've never seen pretty well in 40 years of benchmarking farm businesses. Quite incredible, really. So and things have changed a bit now. We've moved back to what is more a more long-term scenario economically in terms of the commodity prices. Most of the commodities have now moved back towards their long-term averages, and which is what commodity prices do. And we've got a situation where interest rates are now they've moved back towards towards what the long-term average interest rates have been over the last 20 to 30 years. So we've just basically the needle has corrected back from what was an extremely favourable position in all those aspects to a more realistic position, I think.
Jeff, what's your take on where we find ourselves now compared to a couple of years ago?
Yeah, thanks for having me too, Hutch. Exactly like Greg said, there was certainly, and there's pockets that vary, but the last 2 to 3 years have been pretty good. Certainly with rainfall and commodity prices, everything else, and obviously we've had we had high input costs last year as well, but they were easily absorbed by most with the returns. Whilst not doom and gloom, we're probably settling down. The interest rate's an interesting one where I got asked at a conference a month ago, when are they coming back? Or there was a comment along those lines, and my answer was, well, we're still under 20-year averages on interest rates, and for our economy to work well, floating around where we are now is sometimes a nice fit where they're affordable. They're not in the teens, and there's a return on investor money as well. So probably putting all that together and heading forward, we've come off a good platform to go forward, but sort of understanding the numbers is a key now on what are new averages. Greg touched on working on long-term averages in your numbers is always a safe way to go. Banks certainly do that, and it provides the strength to the business.
Jeff, I wouldn't mind extending that if I could. When we have a couple of really strong years and those windfall profits that Greg mentioned, what are some mistakes we can make? I think often as humans we have short-term memory, and so we can think that this is our new reality. When we're in those moments, what are some mistakes that people can make on the back of a couple of good positive years?
Yeah, look, back a few years ago, I used to read one of the banks used to put out what they called, business confidence and ag confidence. And I used to try and get my head around that word confidence. And I've seen it firsthand in the last 12 months, 18 months. When a farmer's, he understands a bad year and suddenly has a good year, it gets a bit confident and, orders machinery and gets a bit braver. And obviously the other psychology is every year when they put their assets and liabilities together and they put their land down at the new average as it's been going through the roof, they feel wealthy. They're looking at a much stronger asset position than they used to have. So the mistake sometimes off the back of that is to act off a feel and not the numbers. The feeling of confidence and the feeling of wealth, because there's a danger of overcooking it, and it could be that new machinery or extra land or whatever. Off the back of all that, the equity's good. There's still a lot of farmers out there that make decisions off the back of equity. They figure on a land to debt ratio, if they're sitting under 50%, they're feeling pretty safe. But now that we've, in a lot of areas, the land value's doubled, that's a significant amount of debt that, at now higher rates. And remember, banks have to calculate the ability to repay it on a principal and interest basis. Even if they're interest only, they still have to calculate that. And there can be some pressure put on that. So it really gets down to understanding your numbers as a business, as a trading operation. When you talk about budgeting, benchmarking, put in your averages on everything and see how they stack up. That's the key message, that there's still quite a few out there that aren't doing that. And they sometimes even get surprised when they find it hard to get finance.
Jeff, just to extend on that, what are you seeing in terms of the bank's sentiment towards lending? And have you seen people sort of take on a lot more debt as a function of increased land values and, put themselves in a real position of pressure?
Oh, absolutely. Absolutely. Sometimes off the back of being confident. I don't want to talk too much about the wine grape industry, but that's the commodity price there is probably 30-year lows, and banks have been quite reasonable on their assessment to look at it from a long-term average. And again, a vast majority of growers don't know their numbers. They know they're losing money now and they're potentially running on a bit of hope. And when the bank sits down and crunches out their numbers, there's a few that are getting exposed where even at average prices, they're very tight. And this is, I've mentioned it before, APRA laws, in the last 3 or 4 years, we've got these responsible lending laws where it's deemed irresponsible for a bank to lend to someone if they can't demonstrate they can repay the debt, because regardless of equity. And we've got cases where even at 20% loan to valuation ratio, people are struggling to show servicing. So if a bank were to lend just on equity, then they're effectively saying that they're going to get their money back by selling them up, and that's deemed irresponsible. So that's the message that both banks and us, and we're trying to get out there, that we've got to understand the numbers. The farmers got to understand the numbers, and some of them are getting a rude shock because they really don't know until they go to the bank and get declined.
Thanks, Jeff. So, Greg, you mentioned needing to know our numbers, and I know a big focus that we have with our members is cost of production. What are some of the key tools and systems that we need to get around ourselves so that we are on top of our numbers and analysing our viability strongly?
I think the first thing, Jeremy, is to be able to understand what it is that your production model can deliver. So whatever enterprise you're running or enterprises that you're running, you need to be able to model that economically and from a production sense, so that you can understand what the potential income generation from those enterprises are, and then what the costs associated with that income generation are. And the best way to do that is by creating an economic model, which is not hard to do, really. It's like it can be done easily in Excel. It's not a difficult process to go through. And once you've got that model together that fits your farm and your enterprise mix, then you can tweak the various inputs and outputs to look at what the results might be. So, I mean, the key really is to become as much as possible a lower cost producer. Now, what does that mean? I'm not talking about a low cost producer is a low cost of production producer. I'm not talking about spending no money. In other words, minimising costs, because what often happens is that if you start cutting back on costs that have a direct relationship to productivity, as you decrease the cost, you decrease productivity, and there's a very, very strong relationship in farming between productivity and revenue and profit. So as you start to decrease, if you decrease costs that have a direct relationship to decreasing productivity, then your revenue goes down, and then your profit generally goes down. So your cost of production actually goes up. So what we find in the majority of benchmarking scenarios is that the low cost producers generally tend to spend more per hectare, but they have much higher productivity and they have much higher revenue generation. So understanding these numbers and how they all fit together and how you can tweak your business model to be able to deliver more revenue at a similar cost base or a slightly higher cost base is the key. And particularly in the grazing enterprises across the country, there's generally lots of opportunity to improve production and revenue. A lot of people run extremely conservative production models in the grazing enterprise side. A little bit not quite the same on cropping. A lot of croppers run pretty technically advanced enterprises, and so they're pretty well on top of what they're doing there. But there are opportunities in the cropping space as well to capture more from the seasons that are delivered to you. I know, for example, in the last couple of years, there's been significantly lower production in some areas based on the rainfall that they've achieved, because people just haven't gone out and capitalised on the rainfall by looking at in-crop nutrition and so forth, and understanding what's going on with nitrogen and response to nitrogen. Even though nitrogen has been expensive, potentially the extra yield that could be gained by understanding what's going on your property, far outweighs the extra cost of the nitrogen input. So I think there are lots of opportunities for people to think about what they're doing and to utilise the rainfall they receive and tweak the model that they've got to generate higher revenue and become a lower cost of production producer.
Thanks, Greg. What's that economic model look like? Is it a 12-month, month-by-month sort of budget, or is it a longer-term projection than that? Can you just give us a visual on what you would suggest is a really robust economic model?
Yeah, well, I think it starts with an annual model. So don't even worry about doing a 12-month cash flow budget on a model that's broken. If the model can't deliver profit, don't spend the time like doing a 12-month cash flow budget, because it doesn't matter how you can budget the hell out of it, and you're still not going to make any money because the model can't deliver the profit. So to start with the annual, what does the annual outcome look like? What's your yield going to be? What's the prices that you're going to budget on? What do the costs look like? Does it make a profit? And once you can start generating or looking at a model for your farm that actually generates a profit, then you can go back and work your 12-month cash flow scenario out to look at what your cash shortfalls and surpluses are going to be. For a cropping situation, I mean, generally you could look at 1 year, but probably you want to look at a budget that extends over the rotation length, because really in the end it's the profitability over the rotation cycle that's the important part, not just 1 year. So I think looking at the profitability of the rotation is the important part there. For grazing enterprises, it probably needs to be at least 3 years, because a lot of the decisions you make this year may have ramifications over the next 2 to 3 years. So you might make some decisions that actually make today's cash flow or this year's cash flow look better and this year's profitability look better, but you'll have ramifications potentially in year 2 and year 3 that actually make the 3-year average profitability lower. So you need to extend that out over enough time to allow those decisions, those critical decisions, to play out.
And I think some of us may have got into the trap of using above average yields and above average prices in our budgeting in recent years. Greg, what should be the assumptions that underline that economic model? Do we need to be going back to looking at long-term average prices and long-term average yields and rates in that assessment, and making sure our business models can be profitable based on long-term average?
Look, ideally, your business model, for whatever enterprises you're running, your business model should be able to deliver 30% net profit ratio. So that's 30% of your revenue retained as profit after all costs have been allocated, including a plant ownership cost or depreciation cost on all plant and machinery, and commercial rate of applied to the labour being supplied by the owners, so a commercial rate. 30% revenue should be retained as profit in an average production year or average yield expectancies, whether irrespective of what the commodity is, and average prices, because that's going to be the results that you get out of your enterprises based on an average year, production year, and average prices will be the likely long-term average for your farm over a 10 to 15-year period. And so if on average prices and average yields, you're making no profit, then your average return over the 10 or 15-year horizon is going to be zero, your average profit. And that's not where the business needs to be. The business needs to sit in a situation where it can ideally produce, it's profitable at a good level with average prices and average yields. And so it's not until you get into those lowest 20% of yields or 20% of prices where you might start breaking even.
And Greg, just to clarify, that is profit after debt servicing and owners' drawings and all.
No, that's before debt servicing. So the costs are involved are the direct cost and the overhead costs, including a commercial rate of remuneration for the owner's labour, and plant ownership. So full depreciation on the plant and machinery that's in the business, but it's before financing costs.
Okay, great, thank you, Jeff. How does the bank do it? How does the bank model our businesses when they partner with us through lending? Is it different to what Greg just described?
No, it's exactly the same principle. And I'll just give you the data because it's actually, if I explain it well, it's not that hard to understand. Gross income expenses before debt servicing. So basically what the banks do from an historical point of view is they grab the profit and loss, they take out interest and they take out depreciation. And so the net profit, whatever it is, gets added up, grossed up, and then they do their calculations on tax, debt servicing and living expenses. So if, as Greg said, what we advocate for is pay commercial wages and then they look after the living expenses. If someone's trading in a trust or a partnership and they're not paying themselves commercial wages, then that has to be allowed for. So what the banks do really simply is they gross up that profit, they deduct those other three components, and they must have a surplus with a bit of a buffer. And when they actually calculate the debt servicing, they allow for interest rates at 2 or 3% higher than what they are now to accommodate rising rates, so they're not putting someone in trouble, if rates went up. And of course, that's been important the last 12 or 18 months. So it's exactly the same if there's no profit there. Now, obviously, when you're looking at someone's historical, you might have weather factors in there and drought factors and everything else. And so, as Greg again said, not just a one-year cash flow budget, but what the banks call a year in, year out, long-term averages on everything, and then do the calculations on that. Because often when a bank's looking at a file, they might have recently taken on extra land and extra debt, and obviously they allow the farmer to demonstrate the extra land's going to bring a return and create efficiencies and everything else. So it's exactly the same analysis. If a farmer isn't profitable, and I don't even like using the word farmer, if a business isn't profitable, then it can't service the debt and cover everything it needs to, and therefore it's going to be in trouble. And that's exactly what the banks assess when they assess lending.
Thanks, Jeff. Greg, just coming back to you, you mentioned cost of production relative to cost per hectare. Can costs and profit per hectare actually be a misleading number to focus in on?
Yes. If you're just concentrating on the costs themselves, if you're just basically you're trying to get yourself out of out of a difficult financial position by cutting back on the expenses in the business, then, as I said before, the likely scenario is you'll start impacting production. I mean, you might live for a little while on your phosphorus bank and the fertilizer bank that you build up maybe, but eventually it will catch up with a lot of people. And because of this high relationship or strong relationship between productivity, revenue and profit, you can't afford to drop productivity. And in fact, to me, the key message at the moment with where we're at financially and the current scenario is we should be out there exploring all opportunities to increase productivity, not decrease productivity. And that should have been the focus over the last few years as well, because we had a market situation where the markets were crying out for all of our commodities. That's why they were paying the prices that they were paying. The prices were nuts because people wanted what we produced. So the trigger should have been then, we'll go out and produce as much as you possibly can. And to be very honest with you, it's the same thing applies now. It's production is going to be king. And for the large majority of farm businesses, there's increases in production available to them. And it's not until you reach, according to the law of diminishing returns, it's not until you reach a certain level of production and inputs that you start to actually, your profit figure actually starts to go down. So, it's understanding what your business is. It's understanding the role of the key inputs, how they drive extra production, in a relatively risk-free way, and knowing where it is on any sort of price scenario, knowing where that sweet spot is for productivity and the yield of the various commodities. But commodity prices there's one thing that's kind of immutable about commodities, and that is that they prices will always tend to return to the long-term average. So we'll have periods where they go well above the long-term average. We'll have periods where they go below the long-term average, but they tend to always return to the long-term average. And that's kind of where we come to.
I think you've done a bit of an assessment on current pricing, Greg, just in preparation. I think there are a lot of people out there that are concerned about some of the commodity prices that we're seeing now, and even some panic out there around the commodity pricing that we're seeing now compared to last season. What is our reality, Greg, just as a broad overview?
Yeah, so you're right, Jeremy. And can I preface this by saying that the sorts of prices that have been received for cattle and for lambs in the last 2 years have been outrageous. And if you look at the long-term averages, and I go back over 25 years and I look at the price trends or the price deciles in inflation-adjusted prices. So I bring the historical prices to today's dollars, because that's the only way to properly compare prices, because of the time value of money, the depreciation of value of the dollar value over time. You can't compare directly the actual price, the nominal price for a commodity 20 years ago and the price today. You've got to inflation adjust those prices. But when we do that and we have a look at it, so steers and medium steers and medium cows are now at about the 50th percentile long-term average prices. So they're not great, but they're not bad either. They're just in the average. Trade lambs are at 60% of the long-term average, or 60 percentile price. Heavy lambs are at 65%, the 65 percentile price. 18 micron wools at 68%, percentile. 19 microns 66%, 20 microns 65. The broad wools, 24 is at 10% and 28 is at 5%. So they're definitely extremely low and have been for some time. And you've got to think about this. I mean, there's a lot of that broad micron wool is being stockpiled around the world at this point in time. So I can't see the prices for these broad micron wools changing much in the near future. Wheat's still greater than 80% of the long-term or decile scenario, and barley's at 50%, canola's at 50%. So we've got a lot of commodities now that are just sitting in that 50 to 60% price percentile brackets. So they're not as good as what they were, but they're not by no means disastrous.
Jeff, what's your take on that?
Yeah, absolutely. And you're absolutely right. We get a bit spoiled. People were complaining about interest rates being so high. And, of course, that's only because we had 2 or 3 years of them so low. And you're right with commodity prices. And up in our Northern Mallee and South Australia area, we didn't have a good 21 with rainfall, so we didn't capitalise on that. But 20 and 22, have been really good years. So to review the business and take the emotion out of it and look at the numbers, everything Greg said there makes sense. But the one thing Greg said that I just want to touch on, and again, I just talk about our area in the Northern Mallee where I think GRDC records would say that our average yield on cereals is about 1.4 tonne per hectare, so we're reasonably marginal. In 2020, it was actually, I love it, and I quote it all the time, it was what I call a perfect year because it was an average year. We actually had average rainfall falling when it should have, not when it shouldn't have. We had reasonably average commodity prices. We had average inputs. You could probably argue the rates were a bit low, interest rates for long-term average, but it was an average year. And what I was able to see is a lot of operations that yielded 2 to 2.5 tonne per hectare in wheat and barley, and there were others that struggled to get to 1.4. And the difference was, many prior years investment in machinery and technology, soils, all the investments over time, timeliness, everything else, and those that capitalised on that average year ended up at nearly double what you would call the area average historically. So that's a testament to me that if you're in business, you've got to take into account efficiencies and affordability. You need to be knowing your numbers and trying to do it the best you possibly can. So with all of that in mind and heading forward into this, then there's a lot of people out there that are well set up. They have there's a lot of delving and clay spreading going in on some sandy soils around our area, and that'll have a long-term benefit over time once they get the nutrient up. And therefore it's a long-term plan, and they've got the machinery and the labour to do it. So as long as it's all affordable on long-term averages, it's the way to run a business in the future.
Thanks, Jeff. Greg, you mentioned 30% profit as the benchmark with average yields and average prices through that economic model. I've also heard you say, and I think it's a really interesting point, that our businesses need to be able to break even or better in a decile 2 year.
Yeah.
Would you mind speaking to that? Because I think what we've got to do is make sure that our business models are resilient and that we can also minimise losses in below average years and be set up to be able to perform well in above average years. Would you mind just speaking to that point? I think it's a really key point for our listeners.
I guess that goes to the point that it's unrealistic to expect that all farming businesses in the country are going to be profitable every year because of the dramatic seasonal variation that a lot of people experience. And then we have price variation on top of that as well. So the bottom line for a lot of people who farm in more variable climatic regions is that ideally they need to be profitable 8 years out of 10. So two years out of 10 they're either going to break even or they're going to make losses, and those break even or loss years are compensated for by the profits that they're making in the 8 out of 10 years. And so really, if you're looking to stress test your enterprise models, apply decile 2 prices, apply decile 2 production outcomes to your enterprise models and see how they stack up. And really, they should be able to break even. And if they're breaking even, then you are a low-cost producer. You're a low-cost of production producer, and that will stand you in very good stead for the majority of years. And the responsibility, really, as a manager of a farming business, from my perspective, is that you optimise or take the opportunities that are provided to you when you have good years and good prices, or good years and average prices, or average years and good prices, so that anything that's above the average, you're optimising and taking advantage of those. And when you reach a situation or you have years where climatic circumstances or prices dictate that you're not going to make a profit, then you manage the losses and you don't allow those losses to get too large, because the nature of farming businesses are that they are low profit businesses. Compared to non-farming businesses, they have low profitability. Like a well-managed farm, will generally deliver something between 4 and 6% return on assets managed over a long period of time. So if you allow loss-making years to become extreme, it takes a long time to recover those losses and then get back into the situation where you're actually generating reasonable profits off the back of the assets again. And often what happens, or what we see, is in particularly those areas of reasonable climatic variability, is that people go through a couple of bad seasons, and they make significant losses, and it takes them 4 or 5 years to actually start to recover from those losses, and they just starting to recover, and they go into the next couple of bad seasons. So they just, basically in the end, it's a recipe for not a lot of wealth creation and a lot more financial risk in the business than perhaps what it might be.
And so, Greg, if I do my economic model and at average yields and average prices, I can't make it achieve a 30% profit. And when I put the decile 2 prices and yields and outputs into my model, that I break even in a decile 4 but not a decile 2 year, what do I do?
It's a great question, Jeremy. And this is where I think this is where the art of farming and the farm business management actually really kicks in. You make your money in farming in the decisions you make in the office, not what you do in the paddock. And if you don't do the planning, if you don't spend the time on your model, if you don't look at all the alternatives you have available to you to actually change what it is you do and potentially change the outcome, you just go out and do what you've always done and expect a different result to what you've always achieved, then you are likely to end up not getting anywhere. So to my mind, if you do that analysis and you find that it's not cutting the mustard, your model's not cutting the mustard, I would lock myself in the office and I would work on that model until I actually came up with something that could work and could deliver or as close as I could to the outcome that I wanted to achieve. And there might be some very serious and strategic decisions that come out of that analysis. But if you never go there, you'll never know. And unfortunately, too many farm business owners never go there.
I think it's a great point, Greg. Jeff, what would your comment be on that? If the numbers around my business model don't stack up, what are my options?
Yeah, look, exactly what Greg said about judging the model, and I'll just a bit of an overarching view from banks, just for awareness. The stats are that 87% of business lending in Australia is not ag. It's commercial and retail and mining everywhere else, and only 13% is ag. And when you throw in consumer lending like home loans, we're down to less than 2% of money's lent in ag. And without quoting banks, they have two problems lending with ag. When they lend to business, the numbers are all done. It's all commercial. It's no emotion. There's a rent on a property or whatever it might be, historical trading, very little influence. So when they lend to ag, the two problems are, number one, the variability of weather, and therefore there's an expectation that the people running the business actually have a higher expertise to be able to manage that, because you can manage a commercial property and collect rent without too much skill. But the second part is exactly that, where a majority of farmers, if I call them that out there, are running on emotion. They're running on feel. They're running on doing what feels right. And, there's an old adage, especially with males, that when the going gets tough, they work harder and they work longer and they go through the night, and, their way is to go out and do it. Whereas Greg nailed it, where the actual strategic way to manage through, if you're not cutting the mustard with your numbers at the moment, then sitting around the table, sitting in the office, making strategic decisions and planning your business is actually, so it's nearly like the opposite to what your intuition tells you to do. And it actually doesn't happen with a lot of people because they don't have a structure they don't necessarily have the skill set in their family to do that. They don't seek advice because that's often seen as a sign of weakness, that they can't do it themselves. It is a changing world that needs all that. So often the decision-making, the core decisions around how they do that, they don't bring in the advisors, they don't have a process to run through it. And that's where they fall foul of the banks eventually, or it might be other compliance measures that they can't keep up with because it's not what they do and what they know. And instead of seeking out investing out, now, of course, Farm Owners Academy members excluded in all this hutch because I do all this, but that's the transition. I remember way back in my bank days in the Riverland where, mum and dad on 30 acres vineyard and a house, a bit of off-farm income, and I did this loan and my manager said, we're not here to fund people's lifestyles. This needs to be a business and it needs to stand up. And there's nothing truer than that. They're a business. So the inability, whether by emotion, pride, or anything else, to actually go and do what Greg just said and sit down and work a plan on your business to how it's going to be affordable, and also, be productive over a long period of time for next generations is critical. But so many people don't do it.
Yeah, great comment, Jeff. I was speaking to one of the heads of research at Rabobank the other day, and they were giving us some trends on canola plantings and just the production report that they're about to publish. What I've sort of seen some croppers do, for example, is reduce their area to canola being one of the more costly crops to produce, and even consider fallow as a way of reducing costs. I guess my question is, how much control do we actually have over our cost base? And what are some of the things that we can do to manage our cost base if our costs of production, if that in-office assessment doesn't stack up?
Greg touched on it earlier. Things like canola, and one of the things I'm seeing is everyone seems to be doubling up on lentil plantings this year because, and I'm not a farmer, but everyone had a very good year with their lentils last year in our area, in our state, and the late rains certainly helped that, which isn't necessarily an every year event. And so, being a conservative banker, I have this risk that if people were doubling up on something that the commodity price is good at the moment and it went well last year, that's a field thing and a timing thing, and it might pay off, don't get me wrong, but it's not necessarily a long-term plan. And what Greg touched on is rotations. I deal with a lot of people that will do a spray fallow. They'll put in crop types that they know they, on a gross margin, they potentially won't break even, but they're looking on a 3-year plus plan for that paddock, and it's what they get off the following year with a wheat or another cereal and those rotations. So while they're taking it on a paddock somewhere, they're actually capitalising on what they did last year on another paddock. So it's all that planning, and look, don't get me wrong, a lot of cereal farmers do that really well. It's probably the bringing in of those strategic cropping decisions back to the numbers. It's still got to go back into what's affordable, what's not, what's the machinery costs of doing all that. So we keep heading back to non-emotional business decisions around the numbers are a platform for any business.
Greg, what's your comment on just how much control we actually have over our cost base and some tactical things that we might look at when we are reviewing our business model?
Yeah, I mean, all we can do is react to the circumstances that are put in front of us, and make the best decisions we can. And so, if you're in a situation where you're experiencing or you're about to experience a lower than average rainfall year, or a rainfall year that's going to be quite difficult to successfully grow crops in and so forth, then you still have the ability to make strategic and tactical decisions about a lot of your costs. Now, where it becomes more difficult, I think, is in the cropping space, where you have frosting events. So you might have fantastic crops growing and they're all looking great, and the yield potential looks fantastic, and you have a catastrophic event like a massive frost event. And so you've spent the money, your costs are already there. They're invested in the yield, and all of a sudden it doesn't eventuate. But if you're in a frost, it's part of the farming scenario. And if you're in a frost-prone area, then it's understanding what those risks are, and maybe looking at ways of being able to manage those going forward, using grazing on some of those more frost-prone areas, for example. There's lots of ways that we can think about it, but we do, in the end, we do every cost every dollar that we spend on the business, we make the decision to spend it. We have the ultimate control over our checkbook, and we decide what money we're going to spend. And so when we think about it, we have 100% control over our costs. We don't have 100% control over our yields and our seasons, but we have 100% control over our costs. And we have a good ability to be able to understand how inputs relate to production. And so that's the key, really, is it's understanding how, varying a particular cost in the business, how varying a particular input is likely to affect production, and then what that effect is going to be on revenue and profit. So it becomes tricky, but running a farming business is not. There's probably not too many professional farming businesses in the country these days that you wouldn't consider to be substantial businesses. Most of them have $5 to $10 million plus assets under management. And if you were any other business other than a farming business, and you had that amount of assets under management, you would have some very, very good financial control, some extremely good people in there that know about finances and budgeting and looking at the risks and how the business can react to whatever is going on in its markets and so forth. And so, I find it kind of interesting that we've got in this particular farming industry across the country, we've got large amounts of assets being controlled by people with very little, oftentimes, I'm not being rude about this, but oftentimes very little knowledge about financing, budgeting, and the management of costs and so forth. So I think it's an area that we, as an industry, we need to continue to concentrate on. We need to upskill people, and everybody. If you don't feel personally like you've got the skills in that area, then I think it behoves you to get out there and get those skills, because you'll find that it changes the dynamic of the way you farm.
And for those interested, on Wednesday, the 7th of June at midday, we are hosting an FOA webinar. We've asked Greg to speak to this point on what are the key ratios, what are the key tools, what are the key resources we need to have around us so that we are strong as a business on financial acumen, and we're getting a glimpse of the skill set that we need to be strong in financial literacy. So I'll share a link to that webinar in the intro to this podcast. But if financial strength is something that you need to work on, highly recommend that you join us at midday on Wednesday the 7th for that webinar. So, Jeff, Greg mentioned that we're in control of our checkbook and that we are in control of what we allocate cash to. We're arriving to 30 June again, and I think this one might be a little bit different in that instant asset write-off finishes 30 June. Do you have a comment on decision-making over the next few weeks, given that structural change?
Yeah. It's been the major topic of conversation recently about what does it all mean. Probably just hitting on the depreciation. I actually did a newsletter recently. The key aspect that I tend to focus on in all this, because we have people that are trying to buy things before 30th of June because they want to get a claim against last year at 100%. And then we have others that are actually holding off because they have depreciated all their equipment to zero and had the advantage of all that, and they actually want to build up their pool again to actually start getting these 15 and 20% claims in future years because they're starting from zero base. And so there's a few tactics, and machinery dealers are telling me, in fact, I've got a header sale going on now that was meant to wait to September because the trade, has desperately been sought after to get the claim and things like this. And as we know, and talked about at length in the past, Hutch, there's no such thing as tax avoidance or even arguably minimisation. I don't like that word. It's deferral. All tax is deferrable. So what I've been doing is getting my head around what do the next couple of years look like when someone's claimed their entire pool and everything they've bought up until June, and then they head into next year without having that advantage. And my understanding is under 20,000 assets are still claimable. So I did a few numbers on this and put apples with apples, from a year or so ago with 100% claim and future year. And I like to use the example of if someone bought a $500,000 tractor in July or onwards, then next year they'll claim 15% of that in the first year, and don't take this as tax advice, of course, but roughly 15% of that, and then maybe 20% a year on the depreciating balance after. But the sale of their trade, they've already claimed 100%, so that becomes total profit. So if they're trading 200 grand on that 500 grand asset, they only get 15% of the 500, but they have to actually declare the whole 200 as not technically a capital gain, but it's income and it's profit. And if they have finance on that or anything else, then obviously cash becomes the key here, as the management of cash, because someone might hit a year where they hit that 30% profit mark, and let's just say for argument's sake it's $300,000 next year, next financial year, and suddenly they've artificially lifted that to 500 or 600 because they've sold some assets that they claimed 100% of. And then not only do they then have to pay the tax on that, or they might want to do FMDs or super other strategies there that all take cash, then they have to pay the tax and then they have to pay the pay-as-you-go. that they haven't been paying because they've got their profit down. So the catch up of that, the message I'm getting out to people is preserve your cash at all costs. Use finance for the new machinery and collect the trade in cash and park it away off your term debt ready to take out and use later, because we get to this scenario in the next couple of years where cash is going to be really important, and banks are going to be asking questions. If you've got an issue around your tax now, what did you do with the extra money you had in the last 2 years back then? And of course, if it's disappeared into other areas and not preserved, then there's a day of reckoning. So I hope that makes a bit of sense there, Hutch, on that.
Yeah, it does. Greg, anything to add?
No, I think Jeff summed it up really well. You just need to make good business decisions and not let the tax position drive your decisions, because good businesses pay tax. That's what it's about. And you should be, to be honest with you, you shouldn't pay more tax than you need to, but be happy paying tax, because it means you're making profit. And there's nothing wrong. I've never yet seen a business go broke making a profit. So, I think it's something that, we shouldn't let those decisions around minimising tax drive the decisions we make. If it doesn't make sense from an economic perspective, if it doesn't make sense from a farming business and production perspective, then don't go there.
Thanks, Greg. So just one more theme to explore with you both while I have you. Land prices across the board have largely doubled. How do farmers make informed decisions about whether they can justify an expansion step on the back of the few years they've had? And, this year plays out reasonably. What sort of due diligence do people need to be doing when they are looking at buying the block next door? Jeff, I might throw to you first.
Look, I just want to give you a real life scenario without getting caught in the numbers. A reasonable area around the York Peninsula in South Australia here. Land price there anywhere from $12,000 to $14,000 an acre, which obviously is significantly higher than a few years ago. And of course, with interest rates having gone up, and one might argue that the low rates over a few years have assisted in the drive of that. I did some basic maths on even just interest only. If they bought some land, these people, and we're up to $1,000 an acre as interest costs alone on buying that land if they went out and paid top dollar for it. That's before a bank has to calculate that they pay the principal off as well. And when I asked them what a true lease value would be on that land, their answer was $380 an acre in the same dirt. So when and this is the driver that comes from family farms that are trying to build their asset base. The acquisition of extra land is a huge imposition at today's prices, at today's rates, huge imposition on their repayment ability and their profits to be able to service it. When you look at it from solely a repayment point of view, 380, I would argue, is the average, because that's what is a good return on investment based on what you can crop from it. And, an operator would struggle to pay a lot more than that and without taking on risk. So we've got this dynamic at the moment with land values that, the cost to actually own it and pay debt and borrow for it is far, far higher than what I suppose the real operating cost is, which I put that back to average lease prices. So there's two decisions there. I call them the profit and loss decision, which is, if that was presented and there was an option to lease rather than buy, you would lease every day, because you've got every chance of making money out of it in a normal year. If you look at it from a balance sheet point of view, then you affect the profit and loss because you've got to service debt on that. But some farmers would argue their long-term plan over 20 years to increase holdings to provide for their children and so on and so on. At some point, you got to bite the bullet and buy it. So I probably, it's a bit of a crystal ball here, but I turn around and say one of the main drivers behind increased land prices over the last 3 to 5 years, aside from the lack of the availability of it, has been low interest rates. When people are paying 2% or less, then suddenly their costs, even in York Peninsula, that land would have been a lot cheaper if it was a lot lower rate. Now that we're heading up 6s and 7s, something's got to give. There is a point in time, one farmer goes and buys a few hundred acres next door and he's out of the market for 5 years, because of his debt servicing ability. So something's got to give. Now, I'm not necessarily suggesting that land prices are going to come down immediately or anything else like that, but my crystal ball tells me I don't know that they're going any higher for a while. A bit like what happens in residential markets. They tend to have spikes and then flatten for a while. So that's probably just to put something out there for thought for people.
Thanks, Jeff. Greg, what would your comment be about making that next expansion step?
Well, I think the most important thing is that you've optimised the current business that you've got. If you've got a good business model and you're making, good profits, so if 4 to 6% return on assets managed on the land you currently own, you've got an interest cover of at least 3 times, probably 4 times would be the ideal scenario. The business is in the position to scale at that point of time. The problem you've got is that you've got as Jeff already mentioned, you've got the serviceability issue. So you've got to have the profitability in your model to be able to service the extra debt that you take on. That's the first issue. The second thing to think about is that from a straight wealth creation perspective, and once again, I'm not a wealth advisor, so please don't take this as personal advice. But from a straight wealth creation perspective, the wealth in farming comes from 2 areas. It comes from the capital appreciation of the land, and it comes from the operating returns that you make operating that land. And so, and when you go back and look at the historical price appreciation of rural land, as Jeff said, it's not linear. It tends to be like a staircase. So we have short periods of quite rapid increases in prices, and then fairly long periods of fairly stable prices. Something like 8 to 10 years where the prices are fairly stable. So if you think about it this way, in the periods of those price appreciation periods when there's basically nothing going on, your total return from your investment is the operating return you're making. And so if you've got a model that's just generating extremely low returns, and the 30-year average Australian return on assets managed is 1.4%, which is a very low return on investment on capital. But if you've got a model that's delivering low returns, the only wealth you're generating from that farm asset that you purchased over the period when capital appreciation is low is the operating return, and which makes it a very poor investment, to be honest with you, when you could take that same amount of money, borrow it, invest in residential property, commercial property, share market, which all historically have gone ahead at much higher rates, much higher levels than that. And when they do have downturns, the downturns are fairly short-lived. Particularly in the share market. Yes, there are periods when the share market goes backwards, but it's very short-lived. So think about it from the point of view of the overall wealth creation, because in the end, we're in business, I think, to provide for ourselves and our families and to accumulate wealth over time. And wealth doesn't only come from farming land; it can come from all sorts of assets that provide income and capital appreciation. So there might be better opportunities for investment of your capital elsewhere, if you've got it to spend, or borrowed funds elsewhere outside of farming. But firstly, get your own house in order. The better your farming model is, the better you'll go expanding that model onto an expanded area. And particularly in the cropping caper, if you've got extra capacity in your machinery and you've got extra capacity in your labour force, and you've got good profitability and good debt cover, then you are probably a pretty good candidate for expansion, irrespective of what land prices are, because the 2 biggest overhead costs, or probably the 2 biggest costs in cropping, in a cropping farm scenario, are labour and plant ownership costs. And if they are not significantly impacted, not significantly increased by expanded area, then potentially that expanded area actually will run at a very low cost of production and add very positively to the business. But it all starts with getting your own house in order and having a model that works on the area you've currently got now.
Thanks, Greg. All right, one more question of each of you. I'm mindful of time. Jeff, you're dealing with banks every day, and your team are often sort of working with clients or on clients' behalf with banks. Has sentiment changed? Has there anything changed in this last 12 months that, as business owners, we need to be aware of?
Not really. The banks, as you know, they have to sometimes deal with farmers through good and bad times, and I give them a lot of credit. They've got a duty of care to their clients, and they're the partners. I love that word, partners, because they're also taking the risk on a farmer, and probably the driver and what's coming through. And again, in our area in irrigation with wine grapes, there's a lot of pressure now on the bankers to work out if clients can afford to pay the debt back over long-term averages. Through no fault of the irrigators, by the way. At the end of the day, their commodity prices all-time lows. But again, so what's happening is they're driving through the decision-making process and asking a lot of questions. And what we're seeing is that those that don't know the numbers, those that don't have a plan, those that don't have a long-term plan, succession or anything else in order, they're falling short. And it's actually the irony of all this is they're not necessarily falling short on finance parameters. They're falling short on business management. That's the key. That's a core part, as banks would know, the ability for the people they're lending to make the right decisions, smart decisions to protect their risk for them. That's what they're trying to judge. And the provision of information and the understanding of what they're doing in their numbers is crucial. So, that's I suppose the message I put out there to people around banks is if you're running a good business, you know your business, you've got plans, you've got strategies, they'll be there for you all day, every day, because you've got a plan. It's the ones that don't and are just living on hope or anything else that are starting to find it pretty difficult.
Thanks, Jeff. And Greg, one last question for you, and we'll touch more on this in our webinar on the 7th of June. But what are 2 or 3 key things that you see the top 20% of farmers doing differently?
Well, it's a great question, Hutch, and there's no doubt that I think the keys are that all of the owners or key people in the business have a clear understanding of where the business is going, and they're all on the same page. So they're very focused on where the business is going and what they need to achieve to actually create and manage a successful farming business. The second thing is they have extremely good understanding of their numbers. They know what's going on. They know what the targets, production targets, and the revenue targets are for the year, and they track those monthly so that they know what the cash position of the business is. They're making good strategic decisions in the now, not waiting, not finding out that their things aren't working out as they wanted, 6 months later on down the track when it's too late to make decisions. So they're actively managing their cash, as Jeff said. It's a really important part of it. And I think the third thing is that they are very open to knowledge and learning and always looking for a better way to do things. So I think they're the 3 keys. It's having a clear vision for the future that everybody is aligned to, having a great understanding of the finances of the business and managing the cash, and really being open to learning and doing things different and bringing in technology and new ways of doing things as appropriate.
Thanks, Greg. Jeff, we, as always, value your wisdom, your insight, and your openness and willingness to share in and around that. We really value our partnership and our relationship with RLS Lending. We recommend you and your team highly. As always, thank you very much for your time.
Yeah, thanks, Hutch, and thanks, Greg. Great chat.
And Greg, as always, it's great to get you onto Profitable Farmer and to share some of the insights that you have around, again, what the top 20% of farmers are doing and some of those key metrics that as business owners we need to be hitting. Really appreciate your time as well. Thanks again for being with us. Thanks, Jeremy. Thanks for the invitation and good to catch up with you again, Jeff. It's always interesting to have these chats and sort of, and talk about what's going on in the industry for sure. Thanks, gentlemen. Speak soon. As always, a really compelling conversation when you get Greg Johnsson and Jeff McDonald together. I hope you found that valuable. I don't have a crystal ball any more than any of you do, but we are seeing inflation and it will continue. We are seeing increasing interest rates and that's likely to stay. And we are seeing softening commodity prices relative to other years, more recent years. And so it's so important now that our business models are strong and resilient and can stack up from a profitability standpoint with average yields and average prices. And so encourage you to go and work on your economic model and make sure that you are doing that work with key people around you to build out a resilient business model that can deliver a strong profit in an average season and at least break even in a decile 2 year. I just think they're really good metrics to go and do your due diligence around. I love the concept that a business is only trending in the right direction if its income is growing at a greater rate than its cost base is growing. And to Greg's point, productivity and efficiency gains are just so important. And so really important that in all of this, that we're not sacrificing production and productivity as we go about trying to manage our cost base and our cost of production. Wish you all well. Great conversation. And I will share a link to the webinar on Wednesday, the 7th of June, at midday, where Greg and I are going to talk about this in a fair bit more detail. Thank you, guys. Take care and bye for now.
Thanks for listening to another episode of the Profitable Farmer podcast by Farm Owners Academy. If you're new to this show, be sure to follow us. If you've been a long-time listener, let your friends know about us or come continue the conversation in the Profitable Farmer Facebook group. All the best as you grow your business and create your freedom farm. Until next time, keep being incredible.